Welcome to the Futures Day Trading 101 Masterclass. In this video, we'll cover the essential blueprint for trading futures, exploring market mechanics, the psychology of trading, and how to effectively analyze liquidity, structure, and risk. Our roadmap for this video is comprehensive. We'll start with the mechanics of futures, move into the vital trader mindset, cover chart setup, dive into liquidity as the core engine, and finish with structure, entries, and the trading playbook. Why choose futures for day trading? They offer structural advantages, including extended trading hours, the ability to trade firm capital via prop firms, clear and knowable P&L, and the benefit of focusing on a single, well-understood product. At its core, a futures contract is a derivative. Most liquidity is found in index futures like the NQ or NASDAQ 100, which is fast-moving and popular, and the ES or S&P 500, known for deeper liquidity and smoother price action. While futures markets span metals, energy, and agriculture, most liquidity is concentrated in indices. Originally designed as a hedging tool for farmers, these markets have evolved into highly speculative spaces for various assets. In part 1 of our video, we explore the mechanics of futures. We will break down tick size, P&L calculations, contract sizing, and the role of margin and prop firms to understand how these markets work. Every future has a fixed dollar value per point, known as its multiplier. Once you memorize this for the instruments you trade, your math remains consistent. Remember that micros are 1/10 the size of minis, offering a key tool for risk control. With futures, your P&L is known before you enter a trade. Because the tick value is fixed, your profit targets and stop losses represent a specific dollar amount that never changes, unlike options which are impacted by Greeks or implied volatility. Comparing futures to options, futures offer simplicity for day trading. You have just two actions, long or short, with no strike prices or expiration dates to manage, plus potential tax advantages in the US. Managing risk is critical, and that's where the choice between mini and micro contracts comes in. Micros allow you to fine-tune your position size, ensuring your risk remains controlled without needing to commit to the larger full-size contracts. Margin requirements vary significantly between broker types. While full brokerages require substantial capital, futures-only brokers offer lower intraday margins for active traders, and prop firms provide access to trading capital for a small fee. Funded accounts have become a popular path for new traders. By paying a small fee for an evaluation, you can demonstrate your trading skills and get access to the firm's capital, while limiting your personal risk to just that fee. To summarize the trade-offs, futures offer exact P&L, deep market familiarity, and accessibility via prop firms. However, they are best suited for intraday trading, as swing trading is difficult and overnight holds are restricted or costly. In part 2 of this video, we delve into the trader's mind. Day trading is a challenging pursuit, and your long-term success depends less on finding the perfect setup and more on managing your psychology, drawdown, and emotions. Day trading is strictly defined by opening and closing positions within the same session. While you can choose different time frames to suit your strategy, remember that prop firm rules typically mandate that all positions be closed before the session ends. Why is day trading the hardest game? It's the most demanding, fast-paced, and high-pressure environment there is. You must make split-second decisions on every candle. The antidote to the financial risk is to use the prop firm route, where you trade with real stakes but a small personal downside. Next, let's talk about drawdown. It isn't a failure. It's a fundamental feature. 99% of the time, you will sit in some drawdown because it's impossible to time the perfect entry to the tick. You must learn to relax inside the noise and accept that this is part of the process. To maintain control, you must limit the unexpected. Panic arises from surprise. By setting up your trade, knowing your exact risk, and defining your stop levels before you enter, you eliminate the emotional response to price movement. The real danger that drains accounts is tilt, the emotional spiral following a loss. Whether it's revenge trading, avoiding the pain of a loss by pulling your stop, or trading too long, these behaviors are traps. Recognizing and avoiding these spirals is essential for survival. Moving into part 3, we'll cover setting up your tools. We'll look at the essential software, the news that actually impacts the market, how to mark your key levels, and the optimal timeframes for your analysis. You only need a short list of tools. TradingView is excellent for clean, fast charting. You'll need a reliable broker or prop firm for your execution, and a free economic calendar to track high-impact news that might drive volatility. When monitoring news, focus on the clock, not the result. High-impact news acts as a catalyst for movement toward liquidity. You should classify releases by their impact, red, orange, or yellow folders, and filter out the noise that doesn't actually move your specific market. Before the session opens, mark your key levels. Because futures markets trade almost continuously, session highs and lows, as well as prior extremes like the previous day's high or low, act as a map for potential liquidity. When selecting time frames, adopt a dual approach. Use higher time frames like the daily or 4-hour to establish your bias, and lower timeframes like the 5-minute to refine your entry. Avoid the 1-minute chart as a beginner. It's often too noisy to navigate effectively. Part 4 focuses on liquidity. This is the engine behind every market movement. Mastering the concept of how liquidity drives price action will make every strategy you use significantly sharper. The market is constantly seeking liquidity. It sweeps one level, reverses, and then moves to sweep another. To analyze this, always ask 2 fundamental questions. Where is price coming from, and where is it going to? Answering these will help define your entries and targets. Why are common chart patterns like double bottoms often hunted? Because retail traders place their stops in obvious places. These clusters of stop orders represent liquidity that institutions use to fill their own large positions. Once those orders are absorbed, price often snaps back in the opposite direction. Liquidity takes many forms. Beyond obvious swing highs and lows, watch for fair value gaps, key prior day or week levels, internal session levels, and regular trading hour gaps. Identifying these pools is key to understanding where price is likely to be drawn next. Calibration is vital. Not every level is the final destination. Beginners often make the mistake of assuming price will always travel to the furthest extreme. Learn to identify major versus internal liquidity and be willing to take profit at intermediate levels. Finally, let's look at fair value gaps. These are 3 candle patterns that signify an imbalance in the market. They act as magnets, because price often returns to fill the orders that were left behind before continuing its original trend. Not every fair value gap is a trading opportunity. A trending market is filled with them, and chasing every one can lead to FVG fatigue. Only trade gaps that occur after a liquidity sweep, where you have additional confluence, such as a structure break or a key Fibonacci level. Now let's move into Part 5, Structure and Entries. This is where we combine our understanding of the market's state of delivery with tools like Fibonacci to pinpoint exactly where to enter a trade. Market structure is simply the sequence of highs and lows. In an uptrend, we see higher highs and higher lows, meaning buyers are in control. In a downtrend, lower highs and lower lows indicate that sellers are leading the market. A market structure shift is a key signal that a trend might be turning. It is confirmed when the most recent counter swing point is broken. This often occurs immediately following a clean liquidity sweep, signaling that the previous directional momentum is failing. When analyzing structure, watch for the order block, the final cluster of opposite-colored candles before a move. The change in state of delivery, or CISD, is confirmed when price closes back through that block. Always mark these blocks by candle bodies and prioritize higher time frames for cleaner signals. Choosing between a CISD entry and an MSS entry is a trade-off. CISD entries get you in earlier for potentially more points, but they come with a higher failure rate. MSS entries are safer as they wait for more confirmation, giving up some points for steadier results. Journal both to see which suits your style. Fibonacci tools serve as a confluence ruler. When drawn correctly, from the start of a move to its end, the 50% midpoint, the 0.618 to 0.705 golden pocket, and the 0.786 optimal trade entry level often align with your other structural markers to validate an entry. In our final section, Part 6, we will outline the concrete playbook. We'll examine 2 primary trading strategies, look at a practical example, discuss common pitfalls, and review the risk math required to stay in the game. Strategy 1 is the market structure shift trade. The process follows 5 steps. Set your higher time frame bias, wait for a liquidity sweep, confirm the structure shift, enter on the retracement, and finally, target the opposing liquidity pool. Strategy 2 is the CISD trade. It mirrors the first strategy, but with a more aggressive entry. After the sweep, you identify the order block and enter as soon as price closes through it, getting you into the move before the structure shift is fully confirmed. Let's walk through a real NASDAQ setup. First, identify the higher time frame bias, such as a weekly low. Second, wait for the sweep of that level. Third, watch for the structure break and entry on the retest. Finally, set your target based on the next major liquidity pool. Avoid the common traps that sink day traders. Don't fade the trend, don't demand the full move, avoid FVG fatigue, and never compromise your risk management. Stop-loss discipline is non-negotiable. If a trade doesn't work, exit and move on. Your edge is found in the data. One trade is noise, but hundreds of logged and tagged trades provide the statistics you need. Consistently review which setups offer the highest win rates, then refine your plan to focus exclusively on those profitable patterns. Finally, manage risk above all else. Limit each trade to no more than 2% of your account, and aim for a 2-to-1 reward-to-risk ratio. For those using prop firm accounts, size your risk to survive consecutive losses, ensuring your capital lasts long enough for your edge to play out. Discipline is the final piece. Always plan your entry, your stop, and your target before you click. By defining your dollar risk in advance, you eliminate the emotions that lead to mistakes. Stick to your process, manage your risk, and treat trading as a professional endeavor. Technical analysis is only one pillar of our trading framework. To get the full picture, you must also consider the macro backdrop, the broader environment and liquidity conditions, alongside fundamental factors like scheduled catalysts and market sentiment. Let's recap the 7 essential lines for your trading. Futures offer fixed dollar values for precise P&L, while micro contracts help you manage your risk dial. Success relies on your mindset, understanding market liquidity, following the core sequence, journaling your trades for an edge, and prioritizing risk management. Use this glossary as a quick reference for our key terms, from understanding tick values and margin requirements to identifying market structure shifts, fair value gaps, and optimal trade entries. To keep learning with Hollow Point Trading, check out our YouTube channel, visit our website, or join our community on Discord. We provide structured education built for real markets. Remember, this is not financial advice. Please note that all content is for educational purposes only. Futures trading involves substantial risk and is not suitable for everyone. Always perform your own research and consider consulting a licensed professional before making any financial decisions.